Bollinger Bands are a technical indicator developed by John Bollinger, and they are used to measure a market's volatility and to identify overbought or oversold conditions. What are Bollinger Bands? Bollinger Bands look like this. They are displayed over the price and they are a chart overlay indicator. As you can see, they have an upper band, a middle line, and a lower band. The middle line is the moving average, and it is usually the 20-period moving average. The upper and lower bands are often 2 standard deviations away from the moving average. If you don't know what the standard deviation is, let me explain it. One standard deviation would mean that the Bollinger Bands, this one and this one, would contain 68% of price action. 2 standard deviations, which is displayed here, would show that the Bollinger Bands contain 95% of price action, and a 3 standard deviations away from the moving average would show that the Bollinger Bands contain 99.7% of price action. Now let's understand the Bollinger Bands in a bit more detail. The upper and lower bands measure volatility. And so how can we use this? Well, when the bands are close together, we would know that there's not much volatility. And when they get further apart, we would know that there's more and more volatility as the price starts to move more and more. And then there's much more volatility, as you can see right here, when the price starts moving rapidly in one direction. One way we can profit by using Bollinger Bands is by using them as dynamic support and resistance levels. This works best when the market is ranging. Okay, so as you can see here, price often bounces off the dynamic resistance level and often bounces off the dynamic support level, which are the upper and lower bands for the Bollinger Bands. And this is the idea called the Bollinger Bounce, that would bounce off the upper and lower bounds. And so when the market is ranging, we can profit by selling when it's at the resistance level and buying when it's at the support level. But why is this? Well, traders believe that it's overbought when it's at the upper bound and believe it's oversold when it's at the lower bound. Another idea when using Bollinger Bands is the Bollinger Squeeze. And how this works is that price often squeezes together like here before breaking out in one direction. So how would you profit? Well, I would say wait for 3 candlesticks to close above the upper or lower bounds if you're using a shorter time frame, as it avoids fake outs like these two. But if you're using a longer time frame, these are much rarer, so I would say wait for a single candlestick as confirmation or just 2. There are some limitations to using the Bollinger Bands, as there are with all the indicators. In this case, Bollinger Bands only provide information regarding price volatility, so I would advise using other indicators that would help you get clearer signals whether to buy or sell. I would advise using the moving average convergence divergence indicator, or MACD, or RSI. I would prefer RSI, my personal opinion, but it's up to you. Thank you for watching. I hope you enjoyed the video. Please do like and subscribe. Invest in your dreams. Grind now, shine later.